All right, a flurry of data is expected today as the National Bureau of Statistics puts out key information about Nigeria's economy, including the second quarter GDP numbers, the inflation numbers, the unemployment numbers, and of course, investment numbers. Many are expecting that the economy will contract by as much as 2% in the second quarter and confirm a recession. Now, to discuss what to expect today, my guests are Andrew Nevin, Chief Economist at PWC Nigeria, Abubakar Suleiman, Chief Financial Officer and Executive Director at Sterling Bank, and Alan Cameron, an economist at Exotix, will join us via Skype in London. Well, gentlemen, the big day is here, and many have suggested that it could break the markets because so much bad news is expected today. And Andrew, maybe I should start with the GDP number. What are your broad expectations? Some are suggesting it should be somewhere around 2%. Many are thinking it could even be more in terms of the contraction. What are you expecting?
Well, we modeled this last year going into the oil price shock and with this reduction of volumes, and yeah, I could very well see a negative 2% or even a little bit worse. But we knew this was happening. This is not a surprise to me.
So do you think that all the bad news is priced in? The scenario of more than 2% contraction is already priced into where we see the debt markets and the equity markets? Or do you think that a number around 2.5% could shock the markets a little bit?
I think it's priced in. I think everyone knows what's happening in Nigeria. You don't need the statistics to look at what's happening. You know from your daily life, whether you're in Lagos or other parts of the country on that. So whether it's 2%, 2.5%, 2.2%, 1.8%, I don't think it's going to shock the market one way or another. What the market's looking for is some positive direction on investment, some signals from the federal government that it's a good place to bring in your money. We need foreign investment to balance out the FX situation at the moment. And if we get confidence, we'll go forward on that. So that's what we need. But whether it's 1.8 or 2.1 is not critical at this time.
All right, let me go to Alan in London. Alan, what are your broad expectations? What do you think will be the key message that the markets will be absorbing today as we take a look at the inflation numbers, the GDP numbers, and of course the investment flow numbers as well?
Well, I think, first of all, the GDP numbers are likely to confirm a recession. There's been a lot of debate around this point. And, I would agree with our previous guest in what he said, in that it doesn't matter if the number is -2 or 2.5. In fact, the consensus is -1.6, and I think it'll probably be worse than that. But the markets already expected this. I think, once again, we're looking for signs of what can improve in the next few months. And critically, since, the GDP data, since the period it's recording, we've had some major changes. We've had a change in the foreign exchange policy. We've had a change in monetary policy. And, I think those things will lead to a pickup in investment, and therefore the second half figures could look better. So I think, these are trailing figures. We're not going to be too focused on exactly what they are. Everyone knows it's a recession. The key thing to take away is, to what extent is the changes in the FX market actually improving confidence? And I think that's slowly coming.
All right. Abubakar, Alan just said it's all history, right? So these are trailing numbers. But the trailing numbers, to some extent, could tell you what to expect in the third quarter. And as a player in the financial services sector, what do you think today's numbers should begin to tell the authorities, the policymakers, in terms of monetary policy and fiscal policy about the economy and the challenges that businesses are facing today?
I think my take would be that we should now recognize that this is the time to bring out the big guns, if we have any big guns left in policy. I think the attitude we've taken has been very, in a sense, laid back. I think when you have the kind of negative news we've had in the last 18 months, actually, and the inevitable consequences that we've projected, people should be seen to be moving a lot quicker. Right. So I give you an instance of moving quicker. There are two major decisions the government has taken that I think are extremely positive, but they're very slow in coming. Removing the subsidy on petroleum products, for instance, was something that should have happened much quicker. And at the same time, allowing the exchange rate flexibility that we have seen is something that should have happened quicker. So we were 6-9 months late in doing so, and therefore we worsened the problem. My question is that what are the next set of things that needs to be done that we shouldn't be doing in the first quarter of next year? We should be doing them right now. Right. We need to take the bull by the horn. We need to understand that when we say there is a contraction, it's actually affecting lives, and that is where we should focus on. Right.
Andrew, the IMF has already put out its forecast, 1.8% contraction for the year. From the few things that have been done already, he just mentioned about policy being a bit slow. What are your expectations for the year? Do you think that 1.8 number, if things remain as they are in terms of what we know about the government's plans to spend and what monetary policy efforts from the central bank that we're seeing, what are your expectations in terms of growth?
Well, I think that 1.8 is probably a pretty reasonable number. I mean, the reality is the year's almost over. I mean, we're coming out with the second quarter number -2. The third quarter, we're already 2 months into anyway, so the third quarter is effectively over. I mean, as my friend from Sterling Bank said, I mean, some of these policies that are positive have been a bit slow. We haven't seen the impact. The FX was slow, removing the subsidy was slow. I mean, the biggest thing in terms of getting movement too is also let's get some infrastructure spending. I mean, we all know if the infrastructure was better and power was more reliable, the economy could grow at 10%. So those are urgent things that need to get going. But can they get going this year? I don't know, but there's nothing we can do about the past. All we can do now is go as quickly as we can to get next year's numbers going in a positive direction. So yeah, I fully expect we'll see a year-over-year contraction. And people, I mean, they realize the population here is growing very fast. So if we say -1.8 in Japan, the population's shrinking, okay, it's a little bit of a squeeze. If we say -1.8 here, the population is growing at 2.7%. So you're looking at a 4.5% drop in GDP per capita, which is just massive. So we need to get this turned around.
Right. Alan, if you can just continue on that point, the implications of the contraction that we're expecting for businesses, for the population, what do you think all this means for the policymakers that need to make things happen? What do you think is happening now that they need to be aware of? Because another key number that is going to come out today is the unemployment number. And given what happened in the first quarter with over 500,000 jobs lost, I can only imagine what we're going to see today.
Yeah, well, first of all, I mean, the unemployment series is pretty new, and I personally would be a little bit skeptical about the extent to which that headline unemployment rate captures the economic state of the country. But if you're asking what are the major things that need to be done, I think to me one of the major obstacles was the change in the foreign exchange rate policy, and the reason that was so important is because investment-driven growth is basically the only hope at this point. It's going to be very difficult for Nigeria to grow through consumption, given the dynamics that we've seen in shrinking GDP per capita. And it's going to be very difficult for it to grow through exports, given what we've seen, not only with the Niger Delta Avengers, but also with oil prices in general. So therefore, I think, investment is the key, and you have to get the private sector involved. And the right policy measures in order for that to happen were very much delayed. But I feel like now that they are in place, and they include, positive real interest rates, and they include a floating exchange rate. So I think those are really the two keys for the rest of this year. And, gradually, investment should pick up from a very low base. But like I said, in terms of the unemployment figure, it's probably likely to rise, but I'm skeptical that it really captures the true economic state of the country in the same way that if you look at, the listed space, which we deal with at Exotix, it probably doesn't capture the wider economy that well. So the ability of the market to signal to policymakers what's actually happening is actually not all that good.
Right. Okay, Alan, we'll come back to you in a moment. We have to take a break now. I've been speaking to Andrew Nevin, Chief Economist at PWC Nigeria, Abubakar Suleiman, Chief Financial Officer at Sterling Bank, and of course, Alan Cameron joining us from Exotix in London. We'll come back and continue our conversation. Welcome back to Open Exchange West Africa. There's much anticipation around the release of economic data today. Of course, the GDP numbers, the inflation numbers, and the investment flow numbers are coming out in maybe a matter of minutes. Of course, my guests in the studio to preview that release are Andrew Nevin, Chief Economist at PWC Nigeria, Abubakar Suleiman, Chief Financial Officer and Executive Director at Sterling Bank, and Alan Cameron, an economist at Exotix, joins us via Skype in London. I want to come to you, Abubakar, and I was trying to just get a sense of what we're dealing with here. The banks obviously deal with the real sector, the economy in general. And just give us a sense of what businesses are going through, given what a contraction to the extent that we're talking about means. And if we don't see a reversal of that, what can we expect in the third quarter, when the third quarter numbers are out?
Okay, I have seen three different circumstances where businesses are actually going to contract because of things going on in the larger economy. The more obvious one is what we see with access to foreign exchange. So a lot of people that have both input and machineries from offshore have not been able to make those investments as fast as they need to. And that has meant that you know, in some instances, capacities are being reduced. In some other places, they've actually had to shut down businesses. And that's the more obvious one. The second one I've also seen is lack of access to debt. So we, in an attempt to manage the macroeconomy, we have created a banking sector that is where access to facilities have become a lot more difficult than it used to be. For two reasons. One, obviously, is the liquidity squeeze with what we've done to mop up liquidity out of the system. And the second one is that capital adequacy within the sector has now become constrained. Some of it because of the translation growth on the loans, but also because of the market impact on fixed income when the yields have really gone up. Right. So access to debt capital has become a problem. The last one is what we all see on the street. We think that demand is actually moderated across, especially in the retail space. We think demand has moderated. We know for certain that demand has actually moderated in the real estate space. We've seen both demand moderation and price moderation. So my sense is that the businesses, at least in those two sectors, will struggle. We have tried to compensate for that by putting more resources into agriculture. And in the last couple of weeks, we've seen a resurgence in construction. Those are the things that hopefully should offset some of that. But I really do think that there are things we control today that could help businesses. One of it is we need to ease access to capital for them. The same way we are working very hard to bring in foreign capital into the sector, we need to sit down with the guys who are responsible for local capital, specifically debt capital. And to some extent, the emerging private equity and asset managers within the country, we need to sit down and have a plan around which they can take decisions that are reliable. Right. So it's a tough one, but we can do something about it.
It definitely is tough. Let me speak to Alan. Alan, do you get the sense that it's all around the foreign exchange shortage, the devaluation, in terms of really galvanizing growth going forward? What more can we ask for from the authorities in Nigeria?
Well, I think that was necessary but not sufficient. So we removed the key obstacle to getting foreign investment in the country, and that's going to take some time to come back. I mean, first, we can expect to see some portfolio investment coming back, and we've already seen the beginning of that. But you know, what's going to contribute to growth in a significant way is not portfolio investment, but direct investment. And I think, you know, that we've now removed a big obstacle, but that investment hasn't come yet. In terms of what the government can do, I mean, I think it's pretty limited. If you look at how much tax, you know, the federal government collects, it's not very much. It's on the order of about $100 per person, which even in the African context is quite low. So for, I think, the federal government, it's really about creating a better business environment. And there's some very obvious things it can do. We've already discussed the fuel subsidy. Removing that was a big step. And I think there's some very obvious things it can do in the power sector as well. You know, we're still in a position where the whole, you know, value chain isn't working very well. There's obviously a problem with the distribution companies. And, you know, fundamentally, there's just a need for more money to get the whole value chain working properly. And I think right now, if I was a policymaker in Nigeria, you look at the global environment, it's extremely supportive. You know, dollar debt rates, you know, for financing in dollars are extremely low. So I think there's an opportunity for the, you know, federal government to raise some dollar funding to solve some of these issues in the power sector, and, you know, to do it quite, you know, relatively quickly. So I think, to me, that's just one example of an obvious thing they can do and take advantage of the global environment we're in to solve a problem that exists locally.
Right. Andrew, I want you to speak to the point you made around power. I do get a sense that that is a big challenge, given the history of the reforms of the sector, and of course the current challenges around the supply of gas and revenue collection. Is that something that worries you right now? Because if we don't get power right, we really can't sustain growth, can we?
Well, you and I have had this conversation probably a dozen times on this show, that if power is the single most important issue, and I think as Alan said, I mean, this is a ecosystem problem. I mean, when it was privatized 3 years ago, no one would have thought we'd be where we are today. Sort of the private sector takes over, they're going to do a good job, but a lot of the discos and gencos were undercapitalized. They didn't necessarily have the skills to go. They didn't realize how much investment was required, and now we've ended up where we've ended up. But I mean, to Alan's point as well, this government has massive borrowing capacity, right? And if they borrow and do the right things, the economy is going to grow very, very quickly. So there is a chance to go out and borrow at very low rates, at an exchange rate that's attractive in terms of turning it into Naira, and make some of these investments. But if the government goes out and borrows and makes investments and it's not successful, we're going to work in a worse situation.
Right.
So the opportunity there is to fix it. But the number one thing is to make these decisions and get them implemented to move forward. If we don't do that, we're not going to progress.
Abubakar, do you think that's the key? You're a bit worried about the high interest rate environment locally. Do we need to move a lot more of that borrowing offshore to get more dollar funding, which the economy really needs at this time?
Absolutely, absolutely. I think we are certainly over-borrowed locally right now. If you look at the size of the loans to federal government relative to loans to the private sector, I think it is significant. If you throw in the sub-sovereign, the states have also borrowed significantly in the last couple of years. So you are definitely squeezing out the private sector any way you look at it. The second point we have to make is that it is extremely difficult at the current borrowing rate for the private sector for businesses to be profitable. It's just a fact of life. Right. Forget about the consumer lending side. I mean, at 20%, 25%, mortgages are out of the question. It's just not going to happen. And we don't have the sort of interest rate profile where the longer tenors are actually moderated and don't react necessarily to short-term interest rate policy. Right now, across all the tenors, these things happen. So there's very little motivation really. It's now also impacted the pension funds. They're also beginning to move their money increasingly into risk-free assets with ridiculously high yields. So there's no doubt about it. But the comment on power, I absolutely agree. The problem with power is that the first stage privatization we've done has not really brought in private capital. A lot of what it has brought in has been debt capital from the financial institution, and therefore the financial institution are no longer in a position to provide next level debt for fixing the infrastructures and all of that. So it needs to happen. We need to put those assets back in the market again to get new investors who first of all take out the current debt and then create capacity for the companies to borrow for the investment that's required.
Right, but I also think that there is a capacity problem with the government. We know revenues are squeezed right now, and there's just so many debts out there. When you think about the bulk trader that is supposed to be buying paying all the gencos, that is not happening like it should. So I guess we have to borrow again, right, for that?
You do have to borrow, but the thing is that the government is sitting on so many assets that it ought not to be sitting on. So it's not a lack of assets per se, it's a lack of cash. So we need to decide what government should be doing and what government should not be doing. And where government should not be, and they're sitting on assets with significant value, they should convert those assets so that they can get the cash to do what they should be doing. If government is going to make any progress with the inequality, it's a global thing, but it's particularly serious when you have a recession. If they're going to make any progress with that, they need access to the cash. If they're not going to be able to borrow clean, for instance, or if the cost of borrowing clean is too high, then they should get rid of assets that they don't need.
Right. Alan, as we begin to round up, I want to get your perspective on another data point that we're going to be checking today, and that is job creation. The NBS has a job creation survey, and they always put that out as well. And that, at the end of the day, is what governments are supposed to do, right? Your perspective on some of the programs that we have on the ground right now, and what do you think we're likely to see in the second half? Do you think there could be an improvement now that we have the budget passed and hopefully there will be a lot more spending?
Create an improvement is, the CapEx part of the budget. That's been the focus of this government, and because of the exchange rate policy, they've been, blocked in the dollars that they can raise and therefore in the CapEx that they can implement. So I think that has the potential to change in the second half, particularly if, as we've discussed, they go out and raise some dollars on the international market. In terms of the job creation, it's hard. I find it difficult to make a comment. I mean, if you look at the historical figures, you're somewhere on the order of, 250,000 jobs per quarter, which is, definitely not enough to absorb the incoming workforce, whatever it is. So I think, if it goes up, that's obviously a good thing, but I'm not sure that means that, we're heading towards some kind of, definitive resolution for the state of the economy. There's still going to be some malaise. And if, the government's focusing on where it can make a difference, I think it's got to focus on more concrete, tangible things. That would be my view, but obviously it's open for debate.
All right, we're beginning to see some of that data out now. I'm just tracking some of the information put out by the National Bureau of Statistics. 499,521 jobs created in the fourth quarter of 2015. That's made up of informal jobs, about 95%. That's always the case. It's usually more an informal jobs situation, beating the public sector jobs and formal sector. And incidentally, we're seeing public sector jobs actually shrink by 4,288 jobs in that quarter. Of course, we continue to look forward to more data coming out. We'll analyze them as they come out. Okay, so coming back to investment flows, and a key point has been the liberalization of the currency markets. But many are still disappointed that those flows haven't come in a significant way. Do you think we're still going to see them? We've seen a major move this week, $270 million into the fixed income market. Do you think that's the first of several?
I think it is. I also think that given the level of confidence that is required for people to accept that the new rules are the norm, I'm not surprised that it's taking some time. What they're watching is to see, are we going to retain the rules that we've set them? Are we going to be true to the new set of rules? And by and large, we have. And what we expect to see is that with the first set of investment, others will follow. My own concern about capital is that we also need to pay the same level of attention to capital that already exists within the economy that is not being invested. So we do have a lot of that as well.
Right. Okay, we are still waiting for the big one, the GDP number. That is, I don't think that has come out yet. We continue to track that. Alan, if I can come back to you very quickly on portfolio flows. You've talked about foreign direct investments being significant. Now that we've seen a more flexible exchange rate policy, do you think that is likely to happen in a significant way? And if not, what needs to change in your view?
The portfolio flows are already beginning to come, and I think those are only interesting to the extent that they, are a precursor to real foreign direct investment flows into the, the real sectors of the economy, as opposed to just lending the government money or taking a position in a listed company. And I think those will come. If you look historically, I mean, the figures have been extremely low in the context of the economy. Whether you're calling it 500 billion or now because of the exchange rate move, something closer to $350 billion annually. The foreign direct investment flows have been anywhere between 3 and 5 billion in a quarter, which is just, very small relative to the size of the Nigerian economy. So I think there's scope for much, much larger foreign direct investment flows. And I think, now that the exchange rate is appropriately priced, and if the government is able to give investors the message that it is addressing key infrastructure challenges like power, then I think more money is likely to come in. If I look across the range of frontier economies that we deal with, Nigeria's exchange rate is now undervalued on a real effective basis. So I think that makes it interesting. We've removed a major obstacle. The portfolio flows are just the precursor. The question now is the FDI going to come, and can it come from a very low base?
All right. Andrew, if you can just speak to the forex shortage and the best way to tackle that. We've all made the point that the government could borrow a lot more, but if we stay with the current policy, do you support the view of rationing and maybe focusing on certain sectors? Many have criticized that in the past, but in a situation where we don't have that much, the dollars are just a scarce commodity right now. Do you think that is a way to go?
No, I don't. I just think that the mechanisms around trying to ration, they've proven to be failure here, failure kind of around the world. At the end of the day, it's got to be market driven. And as we've said, I mean, the problem in the oil sector right now is production's down to just, exports are down to a little over 1 million barrels a day. They should be at 1.7. I mean, at $50 oil, if we were exporting 1.7 million barrels a day, we'd actually be okay. Not great, but okay. The problem right now is the issues in the Delta. So what's going to fill that in? I mean, it has to be investment, and obviously portfolio investment comes first. The issue about FDI is it takes a long time to make big investments, to do the research, to get comfortable. And then secondly, we haven't actually made any progress on ease of doing business. I mean, the number I have in my head is we're still ranked 152nd. We're ranked 29th out of 30 of the biggest 30 countries by population. I mean, the government promised we'd move forward on that. If that moves forward, if we went from 152 to 100, we would see massive FDI as people got more comfortable here. So that's an urgent issue for the government, is to send some signals that it's going to be easier to do business in Nigeria.
We're still waiting for the big number, but we have seen the unemployment number now, and that has moved up from 12.2% in the first quarter to 13.3%. And the note here is the number of unemployed rises by 1.1 million people, resulting in the increase in the unemployment rate. We know that the way the MBS calculates this unemployment rate, many have suggested it's perhaps not as it's done in other parts of the world. They've actually created an underemployment rate as well. So Alan, I know you had some big issues around the unemployment numbers, but what does this tell you? 1.1 million new people unemployed in the second quarter.
Well, I think if you look at the extent to which the headline unemployment figure went up, it probably doesn't reflect the full scale of problems in the economy. If you think back to take one example, unemployment in the U.S. hit 10% after the global financial crisis, and I think that clearly reflected the state of the economy at that time. And I think the challenge is it's not a criticism of the NBS, it's just the structure of the Nigerian economy. It makes it where, a very significant share of the employment is informal, makes it difficult to capture in a headline figure something that, meaningfully represents what's going on in the economy. So yeah, I think it confirms what we know. The economy is in a difficult state. Does it tell us specifically how difficult, or does it, is this figure going to tell us anything about a policy recommendation that we could make to the government? I don't think it does.
Right, but Abubakar, maybe you can speak to this point. We know that this government has a social intervention program, and now that the unemployment number is increasing, it makes that a lot more difficult, I imagine. So what's the best way forward? We've all talked about trying to make markets work, and obviously if markets work, hopefully we get a lot more businesses doing well and employing people. But this is a problem staring the authorities in the eye right now. It's a big social problem. In fact, many have linked this to issues around terrorism and the militancy in the Niger Delta. How do we fix this?
First of all, I do agree with Andrew that we should not be intervening in sectors at the point of allocation of resources, or FX specifically. But I do think that we should determine the sectors where we want to see those resources flow into, and then we need to put in place policies that will ensure that even the demand for FX will come out only in those sectors. So, for example, if I make agriculture or food processing very attractive, or transport, mass transit, for instance, at the point of policy and at the point of tariffs, then the investors would actually put their money there, and the demand for FX will be in those sectors. If there are sectors where I don't think resources should be going to, I should make it less profitable for the investors, and then they would essentially take those decisions. The problem with allocating resources at the point of FX demand is that you start to choose winners and losers, and it becomes very unpredictable, and the process will always be prone to abuses, and that's the simple fact of life. I want to tie that to the second point that came up around about ease of doing business. The reality is that a lot of the regulators and regulatory agents we have in the country do not see themselves as collaborators with the private sector, for instance. So there is very little conversation going on about how to make it easier for the private sector to actually do what they do. That attitude alone accounts for a lot of the lack of ease of doing business that we see, because the policies that exist today, depending on how you interpret them, can actually make business easy. The problem is who is the custodian of that policy and what they think is their own primary duty. And then it comes down to the issue of the unemployment figure. It doesn't matter what the headline is. What matters is that it's worse than it was last month. It was last quarter. It was very bad. Now it's even worse. The government does not have the capacity to provide social services to cover 5-10 million people. They just don't. And therefore, they have to activate the private sector. They have to actively activate the private sector. It is not just the foreign investors. I'm actually saying that there's a lot that can be done with entrepreneurs and local investors, a lot that can be done by using the bank as a source of creating capital that hasn't even been done. The same way we have roadshow all over the world talking to foreign investors, we should have roadshows talking to local investors as well.
Right. I think someone has made that point. We need to look more internal in terms of catalyzing the growth that we need to see. And just another quick point which we must get to, the inflation numbers for July are now out, 17.1%. That's up from 16.5% in June. Maybe I'll get your reaction to this. Do you think the bond markets move as a result? Do you think the T-bill market adjusts to this, or do you think it's all been priced in already?
I think that the bond and the T-bill market had actually moved up way ahead of inflation on account of the activity of the central bank in the OMO market. So whether or not there's still room for us to move back to the peak where we went, I doubt it. So we could see some technical movement over the next couple of weeks, but I think fundamentally where the levels are today would probably stay.
Right. Andrew, reflection on the inflation number? I guess it was expected to be bad, so it's in line with expectations.
We're so dependent on oil. When oil was 100 and it goes to 40, 48, I mean, there's going to be, I wouldn't even call it inflation. I would call it a one-time change in the price levels. So the exchange rate is 160, now it's 310 or 315 in the interbank market. So you're going to have a one-time change in the price level. An economist wouldn't necessarily call it, this is not permanent inflation. So I think what you'll see next year is that inflation comes back to where it, in a sense, should be in this kind of market, which is kind of 7-8%, right?
Right. Well, Alan, can you reflect on the inflation number? Do you think will continue to rise? This is the 6th consecutive month we've seen an increase.
Yeah, I think the key, if you look at the headline figure of 17.1, that's a bit less than the consensus was, but the major takeaway is that the underlying rate of inflation, if you look at inflation month on month, it's coming down. And this is the second month where it will have come down. So that tells you that the momentum in prices that you saw in the first half of the year is no longer there. And therefore, we should be heading back to a more normal figure. It's just a question of time. And I think one of the key variables that you can look at in making that decision is, you look at where the parallel market rate was in July, and it's not meaningfully different than where it was in June. I think it was about 7 or 8 naira different. So that, I think that's the takeaway. Underlying inflation is coming down.
Okay, Alan, I think we have the big one out now, the GDP number, and so we can now tell you for the second quarter, confirming a recession, it was down 2.06%. compared to the contraction we saw of 0.36% in the first quarter. And in terms of the key takeaways, the oil GDP was down 17.4%. So definitely big pressure there. Non-oil contracted only by 0.38% in the second quarter. Agriculture, we saw it actually increase about 4.5%. I don't think that's a big surprise. Industries, for the 7th consecutive quarter, we've seen a contraction, this time 9.53%. So no surprises there, given all the challenges with foreign exchange. But we're now seeing industries contracting by almost 10%.
None at all.
That is scary, isn't it?
None at all. And just to quickly note, some of that contraction are actually as a result of the policies that we're using today to manage other problems. So I can tell you with certainty that apart from access to FX, we now have genuinely a case of access to funding as a driver of some of the contraction. And that, I think, is something that can be done. Just quickly to, again, re-emphasize what Andrew has said, we need to look at the inflation number very carefully in making our decision. If we treat it the way you would treat regular, ongoing, sustainable inflation, you are likely to take decisions that are actually counterproductive. And that is so important for the decision makers to bear in mind.
Right. Well, I think we have to wrap it up here. We've seen the biggest of the numbers. We'll continue to analyze it as we go along today. Many thanks to my guest, Andrew Nevin, Chief Economist at PWC Nigeria, Abubakar Suleiman, Chief Financial Officer at Sterling Bank, and Alan Cameron, an economist at Exotix. He joined us via Skype from London. And so there you have it, Nigeria officially in recession.